All right, folks, I'm Logan Alec. I'm a CPA, owner of Choice Tax Relief. I have more in-depth videos on these tax forgiveness methods elsewhere on my channel, but in this video, I just want to give kind of a quick and dirty look at the major IRS tax debt forgiveness programs. We're going to get right into it. I'm going to start with number one. That is the offer in compromise. The offer in compromise is the settlement. Some marketing in the tax relief industry kind of duplicitously, in my opinion, refers to offers in compromise as the Fresh Start program, when that's not really what the Fresh Start program is. If you want to see my video on what the Fresh Start program actually is, check out the link at the top of your screen. But the offer in compromise is the settlement, right? It's, hey, IRS, I owe this much, and then you present your offer to settle for this much, and if it's accepted, well, that differential is in effect forgiven. And the beauty of the offer in compromise program is it's really driven more by what you make and what you own than by what you owe, because your offer amount is driven by what's called your reasonable collection potential, which is the sum of your monthly disposable income calculated by the IRS's math, which I've gotten into in extreme detail in my offer and compromise formula video, link to that at the top of the screen. Is the sum of your monthly disposable income by the IRS's math multiplied by a future income multiplier, either 12 or 24, depending on what kind of offer you're submitting, plus your available plus your equity and assets. According to the IRS's math. Okay, this is in a nutshell. If this doesn't make any sense, go watch my super in-depth hour-long training on the offer and compromise formula. Link to that video was at the top of the screen moments ago, but now is in the description below. But in a nutshell, if you have millions and millions of dollars of tax debt, right? But according to the IRS's offer and compromise math, your reasonable collection potential is only $100. That's what your offer is going to be, $100, right? You might have to fight that, go to appeals and fight that. But if everything is by the book, everything is per the IRS's own collections procedures manual, the Internal Revenue Manual, then that's your offer and compromise amount. There's some other nits in there, like, well, if the government would get more in an installment agreement equal to your monthly disposable income times the number of months until the CSED, that's when your tax debt drops off. IRS may reject the offer as not in the best interest of the government, et cetera, et cetera. So, this is just the offer and compromise in a nutshell. Bad news, though, is that the IRS actually rejects the majority of offers in compromise. There's multiple reasons for this. I actually have a video I recently made on the channel called Why the IRS Will Likely Reject Your Offer in Compromise. Link to that video is at the top of the screen. You can learn why the IRS rejects the majority of offers in compromise. Many states have their own offers in compromise programs, by the way. However, in my experience and the experience of, I believe, probably the majority of tax professionals who are in the tax relief space, state offers in compromise are much more difficult to get accepted than IRS offers in compromise. There's various reasons for this. For example, many states have a 20-year collection statute of limitations, meaning they have 20 years to collect a tax debt. IRS only has 10 years, right? And if a state knows that they have longer, they have 20 years to collect a debt, probably less likely, they're going to settle a tax debt in year 3 or something. Right, especially if the taxpayer has future potential for income or something like that. There are some things you can do though to maximize your offer and compromise chances, its chances of being accepted. You want to make sure that you've met the IRS's baseline requirements. Right, this means you're in filing compliance, generally the last 6 years of tax returns. You want to make sure that you're in payment compliance for the current tax year, because the IRS doesn't just want to grant you an offer in compromise just so you can get in dig yourself a deeper hole, right? So make sure that for your current taxes, the year we're in right now, you're paying in your estimated tax payments if you're self-employed. You're having adequate taxes out of your paycheck if you are employed. You can't currently be in bankruptcy either. To file an offer in compromise. So those are the baseline requirements. And then on top of that are kind of the numerical requirements, which I alluded to moments ago. Make sure the offer math checks out. it can get complicated. I mean, it's not super easy stuff. Some people fill out the form 433 AOIC, which is the form where you calculate your reasonable collection potential, your offer amount, and they just treat it like they're filling out, I don't know, like a mortgage application or something. They're just putting like actual, it's actually more complicated than that. The IRS has standards that they cap your expenses at. There's kind of like multipliers and haircuts you can get for certain assets. So if you need help, right? If you need any help with your back taxes, reach out to us at Choice Tax Relief, 866-8000-TAX. It's 866-8000-829, or visit us on the web, choicetaxrelief.com. So, for the offer compromise, 433 AOIC is the form to fill out, plus the form 656. You want to mail those with your application fee, your down payment, if you're required to make one, and other supporting documents. Make sure you mail that to the right address listed in the Form 656 instructions. That will all maximize your chances of your offer and compromise getting accepted. For more information about more tips about how to get your offer and compromise approved, check out my video at the top of the screen where I go in depth about that. So that's the formal IRS debt forgiveness program. Okay, it's the offer and compromise. It's difficult to qualify for, right? And when the offer examiner is reviewing your offer, it almost feels kind of like an audit, right? They're looking through your bank statements, they're making sure it matches what you're saying on the 433. It's a very in-depth process. So that's the actual IRS debt forgiveness program. But there are other programs, other tax relief options that you can utilize. While they're not it's not technically a settlement, not technically like, oh, this is, forgiveness, we're writing off this amount, right now because you submitted this thing. There are methods to actually reduce the amount you're paying the IRS and paying them less than you actually owe. One of those is currently non-collectible status. I have a whole video about currently non-collectible status. Link to the videos at the top of the screen and in the description below. So this is a special hardship status with the IRS, in which the IRS basically says, "Hey, you're dirt broke. You don't have to pay us anything right now." They could kick you out of CNC status down the line if you start making more money or your financial situation changes, but if that's not the case, if you're older, retired, on fixed income, not going to make much more money than you're making right now, CNC might be the way to go. Stay in CNC, right, until your tax debt drops off. Tax debt drops off 10 years after assessment. That those 10 years can be extended. The statute can be tolled is the technical term for various things. That's probably getting too technical for our purposes here. But CNC is an option that works out for many folks, right? And it results in them not paying anything towards their tax debt, right? Because they stay in CNC until their tax debt drops off. And there you go. Now, CNC status does not lien-proof you. The IRS will likely file a notice of federal tax lien against you once you're placed in CNC. This is to protect the government's interest, okay? Because oftentimes, well, not oftentimes, but a lot of the times when we get someone in CNC status, it's because they fit that profile, right? Older, fixed income, retired, whatever. But they might have equity in their home, right? Might even have a paid-off home. But they can't access that equity in their home, right? They can't, they don't have much income, right? And maybe their credit's not good. They can't get the equity in their home. So, that equity, though, it still counts for offer and compromise purposes. So they're precluded from an offer and compromise. But if we can show that, hey, a couple banks denied them for a loan to get money out of their house to pay you IRS, we can oftentimes get them in CNC status, right? But the IRS will file a notice of federal tax lien against them so that if they decide to cash out of that house, sell the house, that the IRS gets theirs before the taxpayers get theirs. So it makes sense when you kind of think about it. I do want to stress again, the IRS can systemically remove people from CNC status. If they start making more money, file a tax return, that's making significantly more money than you were previously, you might get kicked out of CNC. Another option that can work for folks is a partial payment installment agreement. And as it sounds, this is an installment agreement in which you partially pay your tax debt. Right. So as it sounds, it's kind of like forgiveness, right? This is a partial payment installment agreement, not a full payment. This is you're partially paying what you owe to the government. Unlike an offer and compromise, it's not a settlement that's paid within a certain number of months, 5 or 24 months. This is something where you're paying all the way until your tax debt expires, 10 years after date of assessment. And this is largely driven, just like C&C and offer and compromise, by the financial analysis, right? Difference between C&C and a PPIA is that in C&C, the taxpayer has no accessible equity and assets, and they have no disposable income. PPIA, typical scenario, is the taxpayer doesn't have any accessible equity and assets, but they have low disposable income, or at least low disposable income compared to what they would have to pay every month if they were fully paying their debt in an installment agreement, right? And oftentimes this is the way to go for people who owe a lot of money. We deal with folks who have been assessed millions, especially in trust fund recovery penalty. That's the back payroll taxes, right? For the employee's share of payroll taxes that a company withheld, but they failed to remit to the government because they had to, put it back in the business for cash flow, or if the owner's really shitty, take it out. And those can be immense, right? Millions and millions of dollars, right? In these trust fund unpaid payroll taxes, right? Now the business is defunct, right? The other payroll taxes, right? The employer's portion dies with the business. The owner is still left with the trust fund portion, right, which the IRS assesses on them individually via the trust fund recovery penalty. And that's a heck of a lot of money, right? Oftentimes, though, even though the owner isn't maybe making as much money as they used to be because they, they no longer have this business, they might still have a nice home, they have equity in it, precludes them from an offer and compromise, but hey, they can't access the equity, so we're going to go for a PPIA. That PPIA might be for thousands of dollars a month, to be sure, but it's a heck of a lot better than paying $2 million off or $5 million off, in the next, 6 years or something, right? So that's PPIA. Like C&C, government will generally file a notice of federal tax lien once you're in a PPIA. And the IRS can review your PPIA every couple of years. That's actually in the Internal Revenue Code itself, Section 6159D, if you really like reading the Internal Revenue Code. There's also penalty abatement. This technically is not a forgiveness of taxes, but it can reduce your total balance with the IRS, right? The most common IRS penalties that we see among our clients, well, the most common one that they basically all have is the failure to pay penalty, which is 0.5% a month of your balance due to the IRS for every month you don't pay it, right? Caps out at 25%. The other is the failure to file penalty. So we see this a lot with non-filers or people who file their tax returns late. This is 5% of the amount due on the return per month. The return goes unfiled, capped out at 25%. The sum of these, both are running at the same time. The failure to pay penalty reduces the failure to file penalty, so the maximum of both penalties combined is, I think it's, 47.5%? Did I do that math right? 47.5%, which is almost half the balance, right? The original balance on the return, right? That's huge. And this isn't even talking about interest. This is just penalties, right? So, theoretically, you owe the IRS $100,000 for a return, and you were, at least 5 months filing it late, or, 5+ months filing it late, or, and it's been over, 3, 4, 5 years, right, since the return was due, or the payment was due rather. You could be looking at a $47,500 combined penalties for failure to file and failure to pay. Man, if you could knock that out, that'll save you a lot of money, right? So one thing we often look for our clients is penalty abatement. Sometimes this abatement is simply just based on the taxpayer's past compliance history, having been a good taxpayer in recent years. Sometimes the argument is more in-depth. That's called reasonable cause. You have to make a connection, typically between something that happened in the person's life that directly affected their ability to file their return or pay their taxes on time. But penalty forgiveness, always worth a shot, right? Even if you're not paying a professional, I would recommend, if you owe tax debt, to call the IRS, say, hey, is there anything I can do in terms of penalty abatement or forgiveness? You'd be surprised. You'd be surprised at what they might say. Another form of tax debt forgiveness, and I just throughout this whole video, I'm using forgiveness loosely. But another form of tax debt forgiveness is innocent spouse relief. This is where your spouse or your ex-spouse made a mistake, possibly knowingly, possibly unknowingly, on a married filing joint return that you were on as well. This could be underreporting income. This could be overstating tax deductions or taking tax deductions they weren't allowed to take, right? Now, let's back up here. I mean, typically what the typical scenario is a business owner husband and the wife either, is oftentimes a W-2 employee, or she, works full time at home taking care of the children, right? Typical scenario, right? But that's just what we see, right? And oftentimes, right, they file their taxes jointly. Wife doesn't really know much about the husband's business. She knows what he does, but she doesn't know what's in the books, right? She doesn't really know. Let's say the husband cheats, on his books and tries to write off, the family vacation to Europe as a business expense, right? So, on the tax return, let's say it's a Schedule C, let's say. On Schedule C, right, instead of the $10,000 or $20,000 in travel expense that was legitimate business travel, he wrote off this $30,000 luxury trip to Europe, and so the travel expense is $50,000, right? Even if the wife looked at that, would she have known that $50,000 sounded off? And that's kind of what the argument boils down to. Did she know, or should she have known, right, that it was off? If the husband travels a lot for business anyway, she probably, would look at that and not know if 20 or 50 was right? But if the husband never traveled for business, right, and she was reviewing that return, that might not be as good an argument, right? Because if the husband has, $20,000 or $50,000 of travel expense on his Schedule C, before signing that return, theoretically, wife may have wanted to question that and say, husband, what is this travel expense? You never travel for work. You work from home upstairs. So anyway, this is probably getting into the weeds, but essentially what innocent spouse relief is basically the innocent spouse basically getting off the hook for taxes, penalties, and interest attributable to their spouse's or ex-spouse's tax shenanigans, okay? And the burden is on the innocent spouse to show that they did not know or had no reason to know, okay, that the tax return that they signed was incorrect, leading to the tax balance, and that it would be unfair for the innocent spouse to have to pay, these taxes, right? Because oftentimes the IRS catches it, right, and disallows these deductions. Innocent spouse says, I had no idea about this. Often by this time they're divorced. That's where innocent spouse plays in. But you don't have to be divorced. You can still be married and get innocent spouse. They also consider things like whether you or your spouse, or whether your spouse or your ex-spouse abandoned you, or if you personally receive a significant benefit from the error. So there are hoops to jump through, right? It's not necessarily an easy argument to make in most cases, but in the innocent spouse cases we take on, we've generally been quite successful. But I want to stress this. I think I've kind of alluded to it a few times. It's not enough for you to have been ignorant of what your spouse or your ex-spouse did on the tax return, right? Spouse hands you the tax return to file or to sign. You sign it. No. By signing that return, you have a duty to review it. Because when you're signing that return, you're saying under penalties of perjury, I believe this return to be true. Okay? So you should be reviewing that tax return, right? So it's not only did you not know that your spouse or ex-spouse was playing games with the tax return, but should you have known, right? Had you gone line by line through that return, should you have known that your spouse or ex-spouse was being overly aggressive on deductions or underreporting income or something like this? Very facts and circumstances based. Let's just say that. So those are the major kind of tax debt relief programs. I'm going to talk about a couple other things here that aren't quite in that category, but still can reduce one's tax debt. First one is simply contesting your liability if the IRS has filed a substitute for return that's an SFR for you. So if you haven't filed a tax return for a given year, the IRS may prepare a tax return for you. That's called a substitute for return or an SFR. Right? And they generally, your tax on an SFR is overstated because the IRS is assuming standard deduction. It's assuming that if you're married, or if it thinks you're married filing separately. And if you're unmarried, that you're filing single as opposed to head of household, which is possible. It's assuming no dependents. It's assuming no deductions other than the standard deduction. Did I already say that? So, especially for 1099, right, and you have a lot of business expenses, IRS is going to calculate your SFR just based on your gross 1099. However, you can fight that, contest that liability. I hesitate to use the word forgiven here because it just doesn't sound right. But you can get that liability lower by filing an original return to replace the SFR. And then there's also bankruptcy, but that's not an IRS tax debt forgiveness program because that's not administered through the IRS, right? In bankruptcy, the IRS is just one of many creditors, in the bankruptcy, along with, the person's, medical bills and their, credit card companies and whatever, right? The IRS is just another creditor there. It's not with the IRS. Bankruptcy is a legal process through the court system. I'm not a bankruptcy attorney, but I'll just share a few thoughts of bankruptcy here. Generally, only income taxes are dischargeable in bankruptcy. So if you run a business and you withheld, FICA taxes from your employees' paychecks that you didn't pay, kind of going back to that trust fund thing I mentioned a few minutes ago, that you're not going to get out of that in bankruptcy. So we're generally talking about personal income taxes here. For most individual taxpayers, when we're talking about bankruptcy, we're typically talking about Chapter 7 or Chapter 13. There are other types of bankruptcy filings available to individual debtors, but Chapter 7 and 13 are the most common. Chapter 7, that's the liquidation. And this is where the bankruptcy trustee will liquidate your assets, except for certain exempt assets that are protected from liquidation. And those exempt assets can be quite substantial for the average person. Okay. And sometimes people get this confused because when we're talking about offer and compromise, nothing's off the table. Your entire equity in your assets is considered for an offer and compromise. With bankruptcy, though, there's these exempt assets that are exempt from liquidation in a Chapter 7, right? But anything that's not exempt would theoretically be sold, liquidated, the proceeds of which would be used to pay off your debts. Right? Now, the thing to know is not all tax debts are dischargeable in a Chapter 7 bankruptcy. Okay? In order for your individual income tax debt to be discharged in a Chapter 7, it has to meet 3 requirements. Okay? The tax must have been due, and I'll go through them 1, 2, 3. Number 1, the tax must have been due at least 3 years before you filed the Chapter 7. Okay? So, let's say it's July 2023, okay, or August 2023. That means that the year of the tax you want to get discharged in bankruptcy has to have been due at least 3 years prior to August 1st, 2023, which was August 1st, 2020, okay? So which tax year was due before August 1st, 2020? That would be the 2019 tax return, unless you filed an extension, which means the deadline would have been in October. So you got to be careful, right? Was there an extension filed? These are all important questions to ask. If an extension was filed and you file your Chapter 7 bankruptcy petition on August 1st, 2023, 2019 wouldn't be captured, dischargeable in that bankruptcy. If no extension was filed, then it's possible that the 2019 tax due could possibly be dischargeable in Chapter 7 bankruptcy if it meets the next 2 requirements. The second requirement is that the tax return for the year in question must have been filed at least 2 years prior to the filing of the bankruptcy petition. Okay, so if you file that 2019 return timely, you would have no problem with that because it would have been 2 years before our hypothetical Chapter 7 date of August 1st, 2023. And finally, the tax must have been assessed at least 240 days before you file the Chapter 7. Okay, so, and again, if you file a 2019 timely, the IRS would certainly have assessed the tax greater than 240 days before August 1st, 2023. So, and to be honest, we have seen, and I don't want to like crap on other tax professionals or other professionals too much, because there are some awesome bankruptcy attorneys who fully understand all this stuff. But, sometimes we get a case where the bankruptcy attorney screwed up. I don't want, okay, let's not talk about that. Let's talk about sometimes people kind of self-do their bankruptcy and they don't really appreciate these dates. And they do their bankruptcy, they think all their tax debt's going to be wiped out in their Chapter 7. Actually, 1 or 2 years aren't dischargeable in Chapter 7. They come to us, we got to, deal with the IRS administratively for their debt, right? It gets extra complicated when taxpayers owe like multiple tax years and they've been late on some filings, and it can be kind of a whole big mess of, when do the dates fall? Chapter 13 is the reorganization. In a Chapter 13, your debts are reorganized to allow you to pay them off in a 3 to 5 year plan. Okay. And whether it's 3 or 5 years largely depends on your income. And in Chapter 13, your tax debt is categorized as either secured or unsecured, with your unsecured tax debt being characterized as either priority or non-priority. So this is probably getting like pretty technical, but I want to work through it just for the benefit of you good folks out there. So secured tax debt, that's tax debt with respect to which a notice of tax lien has been filed against you, right, in public record, right? That tax debt contained in the lien is considered to be secured, and you will likely have to pay it off in 3 to 5 years per the Chapter 13 repayment plan. Now, keep in mind the IRS doesn't continually file notices of federal tax lien, right? They typically file one for the year. So it's possible that you may have a lien against you for older tax debt, but not for some newer tax debt. Okay. So generally secured tax debt must be paid in full in the repayment plan. Unsecured tax debt is tax debt for which no notice of tax lien has been filed. Unsecured tax debt is categorized as either priority or non-priority. So if a tax debt for a particular year is categorized as priority, you'll have to pay it off, right, in the 3 to 5 year payment plan, the Chapter 13 repayment plan. But if any of your tax debt is categorized as non-priority, right, then that tax debt, along with the other non-priority debt, is paid out of your remaining discretionary monthly income, which all those other creditors get a piece of as well. Okay, so it's possible that you may not have to pay off all your non-priority tax debt in the payment plan. In fact, many bankruptcy attorneys tell me, it's like 5 cents on the dollar, right? Basically. So this distinction between secured and unsecured, and priority non-secured and priority and non-priority non-secured is very, very important. Okay. So what makes a personal tax debt that's unsecured, right? No tax lien, and non-priority? Well, it's the same rules as for the type of tax debt that's just chargeable in Chapter 7. Okay. The tax must have been due for at least 3 years before you file the Chapter 13 petition. The tax return must have been filed at least 2 years before you file the Chapter 13 petition. And the tax must have been assessed at least 240 days before you file the Chapter 13 petition. So that's bankruptcy in a nutshell. Again, not a bankruptcy attorney, but I feel it's my obligation to at least give you the basics of how tax debt works in bankruptcy for your benefit. But yeah, that's basically it, folks. I mean, that's how you can fight the IRS, and I use the word fight loosely. I mean, oftentimes it's work with the IRS to reach a resolution for your tax debt that is agreeable to the IRS and within their guidelines, and that also works for you. So we at Choice Tax Relief are experts at tax debt relief. My name's Logan Alec. I'm the owner. You can Google me, look me up in Google News. I cite all over the place answering tax questions for various major publications. You want a free consultation, give us a call, 866-8000-TAX, or fill out the form at choicetaxrelief.com. Hope to hear from you soon, folks. Bye-bye.